We have a really big week coming up this week. Coming up on Tuesday, we've got Taco Tuesday happening here at Fluke Hall. It's a wonderful opportunity to come in and talk with our startups. If you haven't done it, if you're one of our startups, then please come in and introduce your startup. Get to know some of the other people in the building. If you're not with one of our startups, but you want to be, that's a great opportunity for you. Next Tuesday, also at 2:30 downtown at Cambia Grove. Cambia Grove is an organization downtown that is really interested in changing the way that healthcare runs in Seattle, in Washington, in the United States. They're a fantastic organization. They're doing this thing called the 5 Points Conference, where they talk about different aspects of healthcare in America and how to change them. This week, it's going to be talking about the provider. So that should be really interesting if you are into the healthcare field. And at 6 p.m., also on Tuesday, February 6th, Seattle Angel Conference is doing a series of workshops at our HQ. Seattle Angel Conference, if you don't know, is a conference not just for angels, but a lot of startups go and pitch to the angels at Seattle Angel Conference. I felt really dumb when I found that out, because I was like, why? Somebody said, why don't you come to Seattle Angel Conference? I said, well, I'm not an angel. And the person looked at me with this like pitying look, because a lot of startups go and they pitch. And they want to get people ready to pitch. They're so active. So if you go to the Seattle Conference workshops beforehand, they'll help you get ready to pitch at Seattle Angel Conference, among other things, and pitch in general. This coming week, they're going to be talking about, is your startup investor ready? And that's going to cover a lot of ground. It's going to cover things like product market fit and your business model, and whether your management team is sturdy enough. All of that is really great stuff to get to know. Today, we don't have an ELC meeting happening afterwards. ELC is the Entrepreneurial Law Clinic. They frequently do presentations after our primary presentation. They're fantastic. They go specifically into different fields of startup law. Next week, in this space, they're going to be talking about corporate basics after our main presentation. I wish that somebody had given me a corporate basics overview at some point when I was early in startups. I think that'll be extremely useful. And our primary presentation next week is going to be from Yi-Jin Yo. He is going to be talking about startup valuation, and he has just an amazing story himself. He was a very highly placed network engineer at AT&T, and they completely rebooted their corporate venture fund. And they had one of their engineers, and it turned out to be him, go over to their corporate venture fund. And so he learned all about them venture financing new startups, and then he moved on to being in venture financing himself. He's really fantastic, and we're lucky to have him. And then the following week, we're going to do all those things again. So the 5 Points Conference that week will be on payers, and the Seattle Angel Conference workshop will be on angel investing, and then the fundamentals will be Ryan Strauss on blockchain. So we're just going to have like a week of amazing next week, and then another week of amazing minus Taco Tuesday the week following. So today, we are extremely lucky to have Nat Burgess. Nat is a founder of TechStrat, and he's been an M&A advisor since 1989. He focuses on the sell side. So he's exactly the right person to be talking to us about beginning with the end in mind, getting your startup ready for an acquisition. He's been an angel investor and a startup mentor since 1994, and a lawyer since 1998. Prior to being appointed chairman of the World Financial Symposium and president of Quorum, he worked for Morgan Stanley's M&A group, helped Activision put the very first generation of multiplayer games on the internet, and interned with the enforcement division of the SEC, somebody you want on your side. He's managed transactions with Microsoft, Google, Intel, Symantec, and many other leading companies across US, Europe, the Nordics, Asia, and Latin America. And he's also raised capital from Vista Equity Partners, Intel Capital, Carlyle Group, Marlin Equity, and lots of other leading private equity firms. He is somebody that we're extremely excited to have talk about getting ready for a sale, thinking about a sale right when you get started. Thank you very much, Nat.
How's my volume? Can you hear me okay? So I'm excited to be here. I have some friends over at at the startup hall who first introduced me to the program here. And In the introduction, you can sort of guess my age from the introduction. I'm an old guy. And when you get old enough, you start to see history repeating itself, and you start to see cycles. So late 1980s, I was at Morgan Stanley. We were doing the RJR Nabisco buyout, which was the biggest leveraged buyout in history at the time. I was a very junior person on a very big team. And that was, barbarians at the gate. It was a big change in investment banking. And then 2000, the dot-com, the build-up to that, we had another cycle that created a lot of wealth, and we learned a lot of hard lessons when it all came crashing down. And we're in another cycle now, which is creating opportunity for all of you, unprecedented opportunity. This is, and I hope you realize that. The amount of capital that's at play, the pace of innovation, the hunger among investors and acquirers for disruptive technology, for energy, for new ideas is unprecedented. And we're running as fast as we can. It's an exciting time to be building a business. What I'm going to be talking about today, though, is exits, actually achieving a liquidity event, selling the business that you've built. And I'm going to try to bias that towards early stage companies because there are a lot of early stage exits. But some of what I'll be talking about will apply to you in 5 or 6 years, 7, 10 years. The average age of a company that sells, by the way, is 14 years. So there are some quick hits. But somewhere along the line, chances are, definitely in your careers, you're going to run into these issues. And so it's good to be prepared. Thank you for the kind introduction. My bias is towards software, definitely towards technology, but we've done some work in life sciences, bioinformatics, biotech, and about 110 transactions now in the software industry. So my first message, and by the way, I understand we're also being streamed to Spokane. So, hello, Spokane. My brother used to date a woman in Spokane, and he got many speeding tickets from the airplanes that would fly over and clock him against the lines and the pavement. And his solution to that was very innovative. He bought a car with a sunroof, and he left it open the whole drive, and he would look up quite a bit. So fair warning. So my first thought here is it's actually quite boring. If you want to live a long time and be healthy, eat less, exercise more, floss, build a great company. M&A isn't the reason you do this. If it is, maybe you should be a wealth manager or go to Wall Street or do something different. You do this to build a great company. And I remember when I started my first startup back in 1994, I was really excited about building a great product. Let's build something cool. And I didn't know yet about the fact that that's about 15 or 20% of the game. And you have a lot of other things that you need to be paying a lot of attention to and thinking about. Things like the team and the cohesiveness of the team and the balance of strengths. The alignment that you have to have so everyone's marching in the same direction and everyone's supporting the same mission. The critical importance of a scalable, repeatable path to market. Build something great, fine, no one cares. You got to sell it. And that's the hardest thing for early stage companies. You need to figure out how to defend your market once you've got some customers. How are you going to keep them? How are you going to keep the other guys from stepping on your territory? And then you can't just sit in a room and pass notes to each other. You have to partner aggressively and early with bigger companies. That's how you, it's almost like a stamp on your company that says, these guys will probably survive. They're not Microsoft, but they're aligned with Microsoft. They're not Google, but they seem to have a partnership with Google. Even if Google's not an investor, it gives you that sort of the halo of the bigger firm, and it means maybe you're relevant beyond your scale. You need to work relentlessly towards cash flow positive. Again, in these cycles we go through, there are points in time where you can get away with losing a ton of money in a race for eyeballs or a race for scale, but those are very narrow windows, and that's a pretty risky game to play. So you need to ultimately build a profitable business. And you need to maintain thought leadership in your sector with continuous improvement. If you do all this, M&A will follow, or IPO will follow, or a great scaling cash flow positive business will follow. This is what you need to worry about first. There are a lot of myths out there regarding M&A and early exits. And there's an idea that, oh, if the company doesn't actually take off as I had hoped, I'll just sell it, get my investors their money back, and it'll be fine. Or I'll find an acqui-hire, someone will pay me $1 million a head for my team. These are things that happen, but they don't necessarily give you the safety net that you will hope you have when things are going sideways. Another myth, my company will be valued the same by investors or acquirers. Well, raising $2 or $3 million in VC at a $20 million valuation is very different from someone taking down $20 million off their balance sheet and handing it to you, right? Because in the first instance, you've mortgaged your life for the next 5 years to make them money. In the second instance, you're going to buy a Ferrari and ride off into the sunset, and it's over. So those are very different scenarios. And then the final myth here, and I've seen this a lot around town, if Google does knock on your door and say, hey, I know you've only raised $500,000 and you guys are early, but we think it might be important for us, and we want to talk about acquisition. That's not the time when you go hire people and launch a process. You're too early for that. You need to take that very seriously because no one has time for games. So there are moments in time when you do have to pay attention to this. Anyway, ignore the myths, build a great company, and question. Out of all the companies that raise seed capital, early stage capital, angel capital, Series A, how many go on to be acquired? Any guesses?
10%.
10%? Yeah. No one knows, actually, so you're as right as I am. But directionally, yeah, 10%. TechCrunch did a really interesting analysis where they tracked, I think for 11 years, startups that were known to have raised seed and angel, and went through, this is an eye chart, apologies, but pre-Series A, so seed, and then Series A, Series B, Series C, Series D, on down the line. This shows you the survival rate, how many are left that didn't go public or get bought or go out of business. And this shows you the proportion that are acquired at different stages in that growth curve. 1 out of 6, 16%, so you're close, get acquired. What about the other 83.3%? What happens to them? What percent do you think go public? Yeah, I mean, it's really small. So the other 83%, you get a few IPOs in there. A lot of them kind of enter the red zone, which is where you can't really raise capital because you don't have the performance to support it. Your team is starting to come apart. You might have a little revenue, and you can kind of shuffle along as a wounded company for a long time. You can get trapped, or you can dissolve or get merged into someone else. Insufficient capital to attract new management, preference stack ahead of any kind of options you might be able to give. VCs have lost confidence and you're stuck. This is not an M&A problem. This goes back to that first slide I put up. Build a great company. Focus on execution. Keep the momentum. Good M&A planning won't compensate for poor execution. Thanks for your attention, and I appreciate you attending my okay. All right. You haven't finished your lunch yet. A couple more things, just a couple more things to think about. When you're starting a business and it's just a hobby, you've made money, you start a winery, that's fun. You can keep writing checks to it, you can enjoy it. Most of us, though, aren't in that mode. Most of us are building businesses, we're going to raise capital, we're going to be beholden to shareholders. We're going to make promises to them that we want to be able to keep. And in order to keep those promises, we should take care of some basic things in how we build the company that will increase our value at the point of an exit. And I'll talk about these individually because they're all important, and they don't take a lot of time, but they are important. So the first is alignment. Alignment's harder than it sounds. You have a board of directors that's responsible for governance, just making good decisions on behalf of the shareholders. You have the shareholders who are greedy, because they should be. They put money into the business. They want a return. You have management that wants a return and good governance, but maybe also a salary and a job. So alignment is more challenging than it sounds. And in most of the early stage exits that I've been involved in, so I invested in Visify, we sold it to Yahoo. I was an advisor with Picnic that we sold to Google. These deals aren't simple. Like, no one is handing off a check and saying, congratulations, here's your money. You might have a scenario where there is a $10 million deal and $8 million is held back as retention bonuses to keep people. Now what happens to my alignment? Investors get 20% of the deal, or maybe their percentage of 20% of the deal. Board really need to look out for the shareholders. Management says, great, I like this a lot. I'm going to have a cool job, I'm going to make a lot of money, and it's all good. So alignment is critical. Trust is critical. Mutual confidence. And for you as a CEO, building these companies or participating in a management team, that requires some regular conversations around, why are we doing this? Where are we taking it? What are our thoughts on valuation? Are we in this for the long haul? And kind of maintaining that alignment, keeping everyone's eye on the prize. Keeping alignment means that if you're going to raise capital, everyone's on board with the math behind raising capital. And a lot of times I'll be called into a situation where a company is choosing between raising capital or entertaining an M&A offer. And this is the classic bird in hand scenario, right? I can raise some money, and then if we execute against our plan, the M&A value will go up exponentially in 3 to 4 years. So now I've got the execution risk, time value of money, or I can sell today and I get a lump sum and that's it. There's no option value. It's worth doing the spreadsheet when you're raising money. And the math is pretty simple. Whatever your exit multiple is today, or however you're valued today, extrapolate that forward with the growth that's driven by the capital. And that gives you an end game that hopefully is palatable enough that everyone says, yeah, let's go do that. Let's go build that value. We're on board. Yeah.
How does a situation like that affect the potential investors? Like if you're trying to raise a round and they know there's an offer to buy it.
It helps so much. It helps so much. So you, if you've already gotten enough market validation that you've got an acquisition interest, and someone is saying to you, we think that you're worth $12 million today, and that's not, Joe next door with a $20 million company, that's Google or someone like that. Now when I'm going to the investors to raise capital, I can tell them, we could bank 12 million today. Instead, we're going to raise 3 from you, and we'll be worth 60 in 3 years. And you get a big chunk of that, and we make more money. How does that sound? So having optionality in M&A is critical. Having optionality in capital raise is critical. The more alternatives you have, the more people want to work with you because they understand that.
And how long, how do you maintain that balance? You have to give people decisions.
Yeah.
Does that go on for 2 weeks or does that go on for 6 months?
Yeah, that's a really good question. You can get gummed to death over time if you let the investor or the buyer control the timeline of the dialogue. So this actually comes from a real scenario. This is a Seattle company. I was on the advisory board. We had a buyout offer from a very large Valley-based company. We had a CEO who wanted to play a much bigger game and who understood the danger that we were facing of getting into a 6-month cycle of just being distracted. And so we put a 30-day clock on it and basically said, in the next 30 days to the guys down south, we're going to make a decision whether to do your deal or not in 30 days. And then to the 3 or 4 VCs that were interested, we said the same thing. We've got a buyout offer on the table, decision time, next 30 days. That's our window. And they were a hot enough company that we could get away with that and have people rescheduling meetings to pay attention to us. That doesn't always happen. But you're right, you've got to put a horizon on it and then just focus. Pick a lane and focus. Companies that are always for sale just struggle. Companies that are always raising money, technically you will always be raising money, but if you're publicly always raising money, you look pretty hungry. So you do have to constrain these windows. So I have a couple of slides here that I wanted to share with you. I did a similar presentation for New Ventures BC. I did the keynote up there last summer. And what they wanted to talk about is how do you value businesses at different stages of growth? And valuation, until you're big enough where you've got earnings-based metrics and comparables, it's a bit of a black art. So there is no math formula that yields an answer, but there is a way of thinking about it that's really useful. When you're at the concept stage, when you're sitting in your classroom or you're sitting at a coffee shop with a friend and you say, what if we did this? I wonder if people would buy that. That's where these things start. And at that point, you need to validate your idea. So you raise some seed capital, and let's say you get 3 or 4 people on board and they're working for equity, part-time. You got something there. But the value that you've built at that point is really, it's not validated yet. You got a team. Maybe there's some acqui-hire value. Someone could save on recruiter fees by harvesting your team. Then you've got your technology deployed at a real customer, and they're actually showing some ROI from using your stuff. The technology is getting validated. You're starting to identify a business model. You're still very early. You're still not going to scale without a ton of work. But now, in addition to the acqui-hire, you've got a time-to-market advantage because you're in a market before everyone else or a lot of other people, and you're validating it. And in an M&A scenario, you've got potential earn-out, right? So no one's going to pay you for your revenue 3 years out, but they may structure a deal that gives you some upside if they achieve that revenue. And then you get into growth stage. So now you've figured out the product, you're validated, customers are generating ROI, you've got a unique value proposition. So every sale isn't highly customized. People can find you. It's repeatable. And you've got a viable financial model. Now you're starting to build some bigger value. You've got discounted cash flow, so there's earnings that you're generating, that flywheel is turning. You've got replacement value. So to build what you have would cost somebody a lot of money, and there would be a time to market factor there as well, because better to have it today than to spend 2 years building it. And I remember this goes back into the Wayback Machine, so I can share this story. But in the 90s, I was working on a deal with Microsoft, and they made an offer on my client for $27 million. My client had spent $9 million building a platform. The business wasn't scaling, but it was a good platform. And I remember it was Greg Stanger who went on to become CFO of Expedia. I said, Greg, how did you get to $27 million on $9 million in replacement costs? And I was young. I was hoping that he would give me the sort of the keys to the kingdom, the secret analytical weapon that I could use to figure out replacement value and time to market. And Greg said, well, Nat, we want to pay about $27 million. So, so time to market multiplier in that case was 3x. That's just where they landed. In retrospect, I know they hired Anderson or somebody to spec out a build, and so they had some other reference points, but there you go. So your growth stage, you've got some new sources of value in your business. And then mezzanine, so now you're a real business, and maybe you're raising debt, you're thinking about a potential IPO. Now the market multiples start to matter. So your peer group, the publicly traded companies become relevant, the comparable prior transactions become relevant, and there's more of a blue book on value. It's less of kind of what the market will bear. And then exit stage, there is a blue book. Now you're public, or you're nearly public, and you've got good comps, and if you're public, you're looking for a 30% premium, and if you're private, you may even, in this market, be looking at a premium to the public market. Forward growth, forward earnings, that's where we all want to get to, because then we've got true optionality. When you're at this stage, you can make a deal happen with a financial sponsor, with a strategic buyer, but you don't have to. You've got all the cards. What is interesting, though, is as a founder and shareholder, as those valuations get bigger, your returns don't necessarily get bigger because of the time value of money and because of the dilution that you're taking advantage of as you raise money. Often the highest return to founders and early investors kicks in during the growth stage. So you've got your seed money, maybe you've got a Series A, or you've figured out how to build a cash flow business that can self-fund. You're on a growth ramp, but you haven't raised that 10, 15, $20 million round. You haven't sort of stepped onto the unicorn boat and taken on all that risk. And this is actually a sweet spot for M&A, and a lot of decisions happen here between big capital or exit. Seattle's criticized actually for having a bias towards kind of the safe lane, the early exit. Steve Singh over at Concur was one of the few guys I know here who's successfully navigated every one of those steps, from seed to venture to transition to SaaS to mezzanine to go public to $8 billion exit to SAP. But yeah, this is definitely an interesting zone for growing companies. Yeah.
Like at that point, I mean, who on the team, like investors, founders, are fighting to keep going? I mean, it seems like it'd be better for almost everybody just to sell it if you have a buyer.
Are you from Seattle?
Yeah. Okay.
You have conversations in these processes where a CEO of a public company will sit down with the CEO of a growing startup, and the public company guy will say, why would you even consider selling? You just put 5 years of your life into building something that's growing. It could be really, really big. You could potentially take it public. Why would you even consider selling now? And as the CEO, a first-time CEO, you're sitting there saying, I was eating ramen for 5 years. I didn't have a salary. Now I could put $5 or $10 million in my pocket. Of course I'll sell. The guy on the other side of the table is on his third deal, and he's got $100 million in the bank, and his perspective is very different. So what I do see, but maybe a more helpful answer to your question, I've got a situation right now where I'm selling a business for a founder. It's going to be probably a $30 million deal. He's already stepped off onto the next thing. He sees a bigger opportunity, and he wasn't able to take his existing company into that new opportunity. So for him, it's, unencumber me. I've got a bigger game to play. So at every situation.
Who left on the team is going to fight to keep going? I mean, because a lot of the investors.
They're going to make money.
Yeah, the investors are going to want to exit the founder.
No, I mean, you have to make it, a longer conversation, but if the founder is stepping off, he's got a good CEO in place, and we do a 5 or 10% management carve out and incentivize the team, it's all good. Everyone's going to make money. So. Okay, so I'm back to the sort of short list of things to think about as you're building a great company that happens to be optimized for M&A or capital raise. And that is just being diligence ready. We're all doing more than we can do, which means we let a lot of things drop. I'm guilty of that. Yesterday I had meetings in Bellevue and Seattle all day long, and by the time I got home at about 9 o'clock at night, I still had about 6 hours of work to do to actually follow up on all that stuff. However, as you're building, there are certain things you can do just as best practices that make you crisp and prepared if there is a capital raise or M&A. One is a virtual data room, and that's just a fancy way of saying there's a digital folder. Like the cloud is just someone else's computer, right? Maybe it's your computer and you're backing it up. But there's a folder somewhere that has your formation documents. It has, you update your management reports quarterly. It's got your IP, any kind of provisional or granted patents. And it's all organized, and you just do that over time. You don't do it over a weekend when you're trying to scramble to respond to diligence questions. And you can look up a diligence checklist. They all look roughly the same. This is a basic corporate practice, though, that you should follow. Documentation of any encumbrances. If you're a technology-based business, just making sure that you don't have any strings attached or you're giving away exclusivity. Funnel metrics, ideas of where the next sales are going to come from. This is housekeeping. It's hard to do over a weekend, but as a set of corporate best practices, it can help you later. And then finally, I wanted to give you 2 scripts. I was on the phone on the drive here with a UK-based private equity firm, and my client would like to buy a company they have. And it was actually kind of a nice conversation because it was so clear. I said to the guy, hey, I've got this guy lined up. He knows the industry. We've got 4 sponsors that want to back him, and so we want to make an offer to buy this business. And the English guy says, well, we're not prepared to sell it, so we'll call you when we're ready. And then I say, well, would it hurt or help my guy to bring an offer that you could respond to? Well, of course we would have to respond to any offers that we received. So he had a script that he was working from. As a CEO, you should have a script as well. If you're building and it's too early to sell and someone's knocking on the door and it's kind of an acqui-hire thing and you're not going to take it that seriously, don't waste your time or their time. Just tell them, it's too early for us to sell. We're building value really fast. Let's figure out other ways to partner together and do great things together. But we're not ready to sell. So what does that do? Number one, it just clears the air. Good. Now we know it's about partnership. Number two, if they're the crazy Ivan who's just got to have you, they're going to lean in. They're going to lean way forward, and they're going to start thinking about your valuation based on your projections 1, 2, 3 years out. And they'll have to come back pretty strong to sort of overcome that barrier that you've erected. And by the way, if they're interested for reasons that you can hopefully leverage in a partnership. And then if you're ready to talk, you have to remember that you have multiple shareholders. You have a fiduciary duty to your shareholders to look out for their interests. You're not going to just get boxed into a corner and do something suddenly and stupidly. You're going to remind them that you do get similar inquiries, and everyone does these days. And that it's a board decision whether to engage. Now it's a process, and it's the right thing to do. So you never have to sort of engage in these sort of preemptive games. You can just put it on the table. The other thing, for M&A, there's always this idea of the buyer really wants something, so they're going to pay a lot for it. And it feels a little bit abstract. But let's turn that upside down. As the emerging company, there are things that you need that you don't have, like resources, development resources, distribution channel, alliances. Maybe you can get those by being acquired. In other words, you're acquiring those resources by joining with this bigger company. These are the deals that really make sense, okay? This is not about a new Ferrari and riding off into the sunset. This is about you saying, I'll give you an example. Instantiations in Portland built a great Java development toolkit, optimized for GUI. And I see you nodding. Have you used this one before? It's Eclipse-based. And at the point when Google released the Google Chrome OS, they were dying for people to build apps for it, their new operating system, web operating system. Instantiations happened to have something that was just perfectly suited to that. So we rebadged it the Google Chrome OS Web Development Toolkit. And suddenly, instead of doing email marketing to 15,000 people, we were getting picked up by Google and being broadcast to tens of millions. And ultimately, Google bought it and open sourced it. And that, for these guys, that was a dream come true because now they're relevant on a global stage. So that's the way to think about this, is what can the buyer do for you? And a similar conversation with the CEO of Garmin the other day, where I brought him a company in Victoria, and he asked me the question point blank, what can we do for these guys? How can we put fuel on the fire? So, yeah.
Do you ever see situations where the buyer is buying the company to intentionally squash them because they have a product that currently they're developing?
Yeah, that is something that it comes up in conversations. And usually it's because people are overestimating the threat that they pose to the buyer. Because having the better mousetrap alone doesn't do it. And over the last couple of years, you've seen Facebook, the big guys, get a lot smarter about not doing that kind of thing out of fear. So instead of buying Snapchat, they're doing stories, right? So they know they can win eventually. Or for, Salesforce used to buy a lot of companies. And then instead, they just opened up the app exchange. Now they don't have to buy them anymore. They can just go in there and be part of the program.
I remember Picnic was a great app, and then it disappeared.
We've got folks online.
Yeah.
They can't hear
Sorry.
you, but they can't hear you. You mind repeating the question?
Okay. Happy to talk about Picnic after. I know I'm running over, so quick note on liabilities, responsibilities of the board in M&A. Are these slides going to be made available?
Yes.
They will. Okay. Click through. I did a presentation for SecureDocs on the liabilities of the board in running an M&A process, which are very relevant to CEOs as well. So I won't go into that here. But that's my lawyer side coming out. Useful information. At a high level, the decision to sell the company is the board's decision. And as the CEO, you may control the board, but you still have to be cognizant of this and operate accordingly to avoid problems with your shareholders later. And one other, just you may hear people talking about the Revlon standard of care and business judgment. The assumption is the board is going to do the right thing for the business. And unless it's pretty clear that they've got conflicts and they're not, they're pretty well protected, but you've got to go through the steps and document your process. All right, when do you start a process to proactively sell the business? Two scenarios. One is things are going really, really well and you've got a lot of interest and your board and your shareholders are saying, let's consider this. Let's take this seriously. You have to make sure you've got enough internal resources to actually survive the process. So you need to look around and make sure you've got finance covered and technology covered. But at a point where you decide it's time, you need to really do it methodically and play the buyers off each other and run a process and take care of your shareholders and find the best home. Because that is your best defense against getting kind of gummed and then left on the sidelines. The second scenario is you're just running out of runway and you need to sell the business. That happens. And a lot of CEOs of successful public companies today went through this more than once. We have a client right now that has a fantastic product. They're having trouble with distribution because people prefer to buy from HP and CA and BMC. And if that's the case and you've got enough runway, go out and make something happen. Don't be shy about it. If you can raise money or pivot or restart, you may be better off. But if you need to go that direction, go early enough. And then in terms of actually managing the M&A process, that's a whole different dialogue and a longer discussion and not really relevant. But you want to clearly identify who has a seat at the table. So M&A committee, you don't want all your shareholders and board members sort of micromanaging you and talking to different people. You just need to establish control over it. You need clear responsibilities, timelines, milestones, and you need to manage it. And you should retain experienced advisors. That doesn't mean as a startup you rush out and find bankers and run a process, because generally it doesn't make any sense at all. But if you are in a process, get experienced help if you're being acquired, or later on if you're going to run a formal process. And there's a lot that those people bring to the table. Chances are this is the first or second time you've done this. Chances are the people who are coming after you have done this many, many times. Okay, that's the end of my presentation, but I'm happy to address any questions that people have. And let's wait for the mic to come around for our friends in Spokane.
Hi, I'm Alex. I have a question on the partner early and aggressively with larger companies. Where is that fine line to not be swallowed by the larger companies and real quick, like be out the door? Or how does that would work?
Yeah, so when you're partnering with larger companies, there's always the sense of they'll see what we're doing and they'll learn from us and copy us. But you know what? Customers do that as often as partners now. There are a lot of companies that get a big account, do good work for them on a SaaS basis for 3, 4, 5 years, and then get kicked out because the company's developed it in-house or they've hired resources to build it. So it's a risk, but that's where this continuous improvement comes in, because if you're a thought leader in a segment, you got multiple customers and you're amortizing all of that work for all those customers on behalf of all those customers, you have an advantage over your partners because you're a specialist in this area, and hopefully you can keep your customers. So sometimes the dance is around disclosure of technology and so on, but I find that early companies tend to be overly fearful of that, and they don't spend enough time thinking about the actual synergies and how they can help. Other questions? Yeah.
So I'm not really sure even how to phrase. Oh, hi. So I'm not really sure how to phrase this, but we're working on an IP basically for a consumer product, and So I was talking to somebody about, what investors want to see, what kind of exit strategy, and what kind of business model. And one idea is we patent it and have, our formula basically, and then license it out to other, like bigger companies. And instead of basically dealing with the whole aspect of running a business, we just go that route and never have to, live off the licensing fees basically. Is that a good strategy? Like, is that an attractive strategy? Like, and when do we decide which way to go? Like, do we decide now, or do we develop the product completely and test it on a consumer segment and follow through with that? Like,
It's a good question. If you asked me as an investor, I would choose not to invest in the licensing approach, and that's because I've been in scenarios where I've gone to Microsoft with a client that has a great patent, and Microsoft says, looks like a pretty good patent, do us a favor and sue us, and over the next 10 years we'll figure out how much it's actually worth. This is the game of kings. It's hard. I know a couple guys in town. There's a guy named Lev Bolotin, the security guy who's done this successfully as an early stage company in security, but it's really hard because you're fighting against well-funded people who they'd rather see you succeed and then buy your company, because now you've got the IP and brand equity associated with the idea and some customers, and now it's real. So that would be my bias. Other questions?
So, thank you for bringing that question up. I have a venture where basically it's also I dance around. Do I license this to other companies, because it's basically a extremely expensive onboarding to get the patents in place. I mean, I have patent bills that I cannot fulfill that are really beyond even a seed stage, and that's where all the magic is in the patents. And I've done the patent world for a while with a little bit of the startup thing, and it's a true burden to, do I make a physical product with this, or do I sell it to these other people? And when you get sucked into the startup world, and this is for a physical product, not a software product, it's a significant barrier to entry. So when for instance, one scenario is I have a small conventional device that's not, it's sort of like the regular world, and then there's a series of patents that come after that are based on a new platform.
Those are filed? Or those are conceptual? Yeah.
Both.
Okay.
There's a lot of them. So how do I determine whether or not I develop the product myself, or just develop a licensing deal and spend all my time in front of companies with a prototype?
Yeah, it's a similar question, and I don't do as much in consumer, like hard goods, manufactured device stuff, because I don't understand it, and I fear it. the support obligations and all the inventory and the fixed costs. But like I said, I haven't seen a lot of truly early companies succeed on a licensing basis because they can't afford to play the big game. And I also have a situation right now where someone had a patent portfolio, and there was one that they thought, well, this is too hard, so we'll give an exclusive license to this. They've been building another business, and suddenly the patent that they licensed out is the most valuable thing they've ever done. And Google and Amazon are chasing it, and they're sitting there going, oh my God, what have we done? So you can't predict where the market's going to go. If you have a product strategy that's underway that's backed by a robust IP roadmap, that's the golden ticket. That's the combo that you're looking for, generally. I mean, if people are knocking on your door, that's one thing. And go talk to Mervold's guys. You got nothing to hide. It's all out there. The patents are all out there anyway. Go talk to them and get their advice, because they're experts in extracting value from patents.
Okay.
Other questions?
Yeah. Of the companies that, or when you see companies that are generating interest, when companies are looking to buy smaller companies, what do you see as the main motivation for that attraction? Is it customers, the technology, the people, the market position?
Yeah, that is a great question.
Like if you were to try and position a small company to be attractive for a higher, what kind of things would you do over the long run to?
Most times, when it's a successful deal, when I say successful, there's a return there, and the team is valued, and the product lives on and grows. You guys are actually not companies; you're products. So, should you be part of a bigger product portfolio where you have a strategic role? There are many examples of this. There's one that's happening right now in town where there's a big company that has 20,000 manufacturing customers, and this big company has been promising these 20,000 customers indoor maps and indoor location technology, IoT data cloud tracking for 5 years, and they haven't been able to deliver it. They haven't really paid a lot of attention. And they're at risk of losing customers. So what do they need to do? Go find someone who's figured that out and buy them. And maybe it's a startup. Or going way back when 3Com was viable, I had a client that they invented and patented wake on LAN technology. So you could talk to a network interface card remotely and wake up the computer. And 3Com was losing I can't remember what it was. It was something like $40 million a quarter in market share. At the time, it was a big number in the network interface cards. And buying these guys basically stopped the erosion. And so that's really, as you're thinking about your product roadmap, you should be thinking about who do we help, where do we fit? Because that's really where the highest value deals come from for early stage. Other questions? Spokane?
Spokane has 13 people, but no questions.
Okay.
Going once. Okay, I have a question. Here we go.
For the legal side of things, which I know nothing about, and I'm a PhD student, and I'm just starting a business for the first time ever. How do I structure the whole legal foundation of my business, basically? So intellectual property, my team. When do we start talking about equity?
Yeah.
That's
an interesting question. It's timely too, because when I do angel investments, I'm typically a late angel, and I'm typically seeing Wilson Sonsini, Davis Wright. I'm seeing the law firms coming in, and often it's deferred billing for IP work or foundational and formation work, and so if you start to get if council is on board and they're excited about what you're doing, they actually don't really care at the end of the year whether they bill you $25,000 or $50,000 for formation or a little bit of IP work. They want the VC round because they can make $100,000 or $200,000 on a big VC round, and they want the exit because that can be $250,000, $300,000. And so, getting in touch with the right people around town who think that way, like Craig Sherman at Wilson Sonsini, or Joe Wallen at Kearney is another guy who really understands startups, and they'll place those bets. So that's the first thing, is get with the right lawyers and treat them like you're pitching them, almost like an investor. Get them excited. Second thing is, for IP work, you need IP people. There's no one size fits all. And then for the transactional work, ultimately in VC or M&A, you're running into employment law, tax law, corporate law, transactional, maybe cross-border, maybe currency stuff. So they need to be pretty well versed in this, and that's where the bigger firms definitely have an advantage.
So do I wait till my business plan is finished?
Yeah.
Okay.
Yeah, and you don't need. There are certain decisions you can make on the legal side that you can never take back. Like, someone will convince you to change your structure to a C corp, because they'll say it's easier to issue options or whatever. Once you've done that, there's a 10-year look back, and if someone wants to buy your assets, you're screwed because you're paying ordinary income tax on everything. So there's certain things you want to be really careful about, but for the most part, you can be up and trading pretty quickly and pretty inexpensively without a lot of fancy legal work. And it's really at the time when you start to have investors placing bets on you is where you start to have to become pretty buttoned down and pretty cautious. The other resource we have in town here is Jim Billmeyer, who he ran some of Paul Allen's companies. He's filed over 2,000 patents himself. And he started something called Turbo Patent. I think the Patent Navigator, I can't remember, they changed their name to one of those. But these guys have it down to a science where they're filing provisionals for a couple $1,000s. They're fast tracking patents all the way through, sometimes for 5,000, 6,000. So, and they're doing it better. So better engineering drawings, higher quality submissions. So I highly recommend, if you have a patent strategy that you want to carry out over time with multiple patents, those are really good guys to have on your side.
What are their names again?
Well, Jim Billmeyer, and it's either Patent Navigator or Turbo Patent. They were one thing, they became another. What is it?
It's Navigator now.
It's Patent Navigator.
Originally Turbo.
Okay, yeah, Byron McCann. They got a really good IP attorney down in Portland. And they're not doing silly things and wasting their time, but if they like what you're doing and you can become part of their strategy, you'll have better patents and you'll save time and money.
What is a good patent strategy?
I think the first is to don't be over reliant on the power of your patents to protect you. So you need a those days are kind of over. So you need a product that people are going to want to buy and a way to build it, so you create ROI for customers and margin for yourself, and that's just what you need. And then people often talk about a foundational patent and then things that follow on from that. So if there's a core thing that you can get in, ideally it's more technical than process, but that's a really good place to start. And typically, like the guys, trying to remember Jesse Chor Spark that was bought by Yahoo. I can't talk about details, but it was a high value transaction, and he had a really nice perspective where he had filed over time 3 or 4 patents, and then he had a roadmap that showed the areas that they had identified that they could still protect. And so when you looked at what he'd done, you realized he had been really smart about where he'd gotten to, and then with more capital, he could protect a much broader zone. Yeah.
So with the kind of emergence of the ICO and kind of skipping over that venture round, how do you see that affecting exit strategies?
I have friends who've made a lot of money in that whole thing, so it's a little. I mean, I'm happy for them, but
Feels like a smash and grab.
I have one friend who invested. He was 26. He invested all of his money, $65,000, everything he could scrape together, in 2013, and then he sold 87% of it to buy a $500,000 Porsche. And the 13% that he saved was still worth $8 million when it peaked. But I'm getting calls. I had one this morning from some people who come across as being pretty crazy, who are involved in that whole world. The one this morning was, let's create yet another currency. There's a couple being invented every day, and we'll do it in Dubai because there's a lot of money there. But it wasn't really very well thought through. And I have another friend in town who actually built a cryptocurrency, and it just took off. It was huge. He was like up for 4 days straight trying to keep the servers going, and then it turned out it was all Russian hackers who had built. They had actually created an exchange for his currency, but it was huge. But 95% of it was. So that's an area that's so dynamic and it's moving so fast. I think the core blockchain technology, if you've got real IP in that zone and it intersects with banking and stored value cards and all these other areas where it's going to be crucial, that's really high value. But if it is a smash and grab kind of business model, then it's not. Yeah, more power to you, but that's not my game.
Anyone? Last question? Well, great. Thanks,
Good.
Matt.
Thank you.
And if you want a copy of the slides and you didn't check in and indicate that, please do. And I will send them out to you later today or tomorrow. Thank you.